Welcome back, everyone. Michael here with Offshore Citizen. Today I'm going to discuss with you what I call, well, let me give some background before I get into that. I've had some people contacting me recently talking about, how to optimize their tax, which is one of the main things that we have expertise in here, and so, not unusual. What is a little bit off is a perception that a bunch of people have been expressing. And I remember, this kind of got popularized about maybe 8-9 years ago. There was some kind of content that was put out in blogs and YouTube and things like this that was inaccurate. And it seemed to go there. And I've recently heard it kind of popping up a bunch again. And so I wanted to address it. And this is what I call the Territorial Tax Myth. So we're going to dive into it today. Before you do, if you haven't already, please hit the subscribe button, hit the all notification bell. Appreciate your support. Thank you very much. If you like our content, please check out some of the others. And if you'd like help with these areas of international legal tax optimization, forming companies, opening bank accounts, getting residencies, citizenships, asset protection, etc., please reach out to us. You can book a call, calendly.com/Michael-Rosmer. There's a link in the description below. Or send a message through our websites, offshorecitizen.net and offshorecapitalist.com. All right, so basically the idea that people seem to have is this notion that, hey, if you want to reduce your taxes, the first thing you have to do is find a territorial tax country. And this is almost universally bad advice and wrong advice. So here's the problem at the root of it, is people have the wrong understanding of what territorial tax means or what local income means. So just really quick recap, most countries in the world, I would say 70, maybe 80% tax on worldwide income. Some of them have territorial tax, and the idea of territorial tax is that they tax only local income, okay? So the narrative goes, all right, my employer is abroad, my customers are abroad, my business is abroad, et cetera, et cetera, et cetera, and therefore I can come to this country and pay no tax. Right? That's kind of the narrative that gets put out there. And this is mostly incorrect. Now, it does vary from country to country, and it does vary based on the type of income. And so we're going to talk about those here and how it might apply to you. So generally speaking, if you are working, doing business in, doing the activities, operations, et cetera, in a country, generally that's local income. And so they're going to consider that taxable. You can see this, for example, with Hong Kong. So Hong Kong has a territorial tax system, fairly famously, but they use what's called the operations test. So they tax operations within Hong Kong. Now, generally, they kind of assume that things are in Hong Kong unless, demonstrated otherwise. So you'll have this concept of the offshore exemption that you can get. You have to kind of go through demonstrating it. Singapore has something a little bit similar. They have a quasi-remittance territorial system, but almost all income in Singapore is taxable. Really, in practice, it's basically like that. I've talked recently about Malaysia, how Malaysia was not taxing foreign source income, then they decided to tax it. Now they decided they're not going to for 5 years. Again, if you're operating inside Malaysia, doing work, business, et cetera, in Malaysia, this is local Malaysian income, okay? We can run down the list. There's a lot of Latin American countries that have territorial tax systems, et cetera. And I think a few of the confusion pieces come in where, first of all, people tend to go to a country, not pay tax, not report it or whatever, and get away with it, and they think, oh yeah, it's perfectly fine, I do this. And then there's kind of this circulation of gossip that takes place, which may not be legal within the bounds of the law, but people are doing it. And the thing you have to understand is most of these countries are not that good at tax enforcement in general. So if you want to move to Paraguay and simply not pay taxes, the likelihood somebody's going to come and harass you is pretty low. So that's not a function of their tax system, although their tax system actually is quite favorable. It's a function of the fact that they're just disorganized and there's not much going on. You can do this in lots of countries. Does that make it legal? No, that doesn't make it legal. So my advice is always figure out the legal way to do things, because there are ways to do that. Maybe it takes you a little bit more work up front, but at least then you never have to look over your shoulder or worry about what's going to happen, etc. This is one of the things that came out for a number of years, or probably a few decades. It was really common that people from the US and Western countries would have money in Swiss bank accounts. And these Swiss banks, the accounts were not reportable. They had Swiss bank secrecy. They said, I'm just not going to pay taxes because how can they catch me? I have Swiss bank secrecy. And that was true until it wasn't. and then there was a lot of people lost a lot of money. So I don't like to rely on these concepts that you can get away with not paying tax. I think it's much better just take the time, put the effort in. Yeah, it'll cost you a little bit of money. Yeah, it will take a bit of time, etc. But to plan legally, if at all possible, in order to make sure it's not an issue. So again, it turns out places like Paraguay actually quite great for tax in a bunch of regards, but doesn't mean that the system works the way that people describe it as working. Now, where people tend to get this wrong is not just that, which is, again, where my customers, because somebody will say, oh, my customers are abroad. I would hear this a lot when I was living in Costa Rica. People would say, oh, there's a Costa Rican territorial tax system. So if your customers are abroad, you don't pay tax, right? No, it doesn't work that way. If you actually go with the Costa Rican tax authority, which is quite a mess in general, they have, and that's a whole other conversation, but this is not the rule. Now, if it turns out you never bring the money into Costa Rica, there's a bunch of stuff that goes around that, but it's certainly not true that the location of your customers determines where you are taxed. Okay, so that's the first thing that is inaccurate. There might be some countries where that is the case. I'm not saying it's true for all, but be aware that territoriality by default does not mean this. Okay. Second, we have where investments are. So I was talking to somebody the other day at a call with, and they were discussing having investments in stocks that were abroad. Well, generally speaking, stocks are considered to be resident as a form of income where you are. So, and this is why if you have, say, stocks on the New York Stock Exchange and the S&P 500 that you're buying as a foreigner, you don't pay U.S. tax when you sell those, even though maybe you're buying Apple shares, maybe you're buying Google shares, maybe you're buying whatever, right? Big U.S. companies, you buy the shares, you sell the shares, you pay no U.S. tax. And that's because the source of the income is not considered to be where the shares are, they're considered to be where you are. And so very often you're going to be taxable. Now, again, where does some of the confusion come in here? Part of the confusion comes in that countries like, say, Malaysia or Hong Kong or Singapore don't tax capital gains at all. So you might say, oh, it's not taxable, it's this territoriality. It has nothing to do with territoriality. It has to do with the fact that they just don't tax capital gains. And so it's not going to be taxable in those cases. So what you're actually looking for in a situation like that is a place that doesn't tax capital gains, not necessarily a place that's territorial, because territorial countries will often still tax capital gains on these foreign assets. Another example that you might come into is interest income, royalties, dividends. Usually when you have territorial tax systems, usually dividends from a foreign company will not be taxable. Usually. There's some exceptions. You can look at the way that Singapore does it. They have a three-part criteria for examining whether dividends are going to be taxed or not if they're foreign. And so it varies. But very often you can receive dividends tax-free if the dividends are coming from a foreign source, if you're in a country that is territorial taxed. And this gives some possibilities for structuring where you can possibly have a foreign company. Where you then get thrown off is, well, will that country consider your company local because of the fact that you're controlling it locally, or will the income be considered local because the operations are local, et cetera. So that gets a little bit more complicated. So when you're doing international tax planning, the objective should not be to look for a territorial tax country, okay? Mostly you should forget that concept. What you should instead look at is you should say, well, what are my sources of income? Do I have a business? Is it earned income? Do I have dividends? Do I have capital gains? Do I have interest or royalties? Like, what is that? Then based on that type of income, you can reverse engineer and say, okay, what are the places that are going to optimize for my type of income? And it might be that you're better off going to a place that's going to tax you at 10% or something, rather than going to a place that has territorial tax, but your capital gains are going to get hit because they still tax those at 20% or something like that, right? This can be the case. Or it might turn out that you go to a country that has quite high taxes, but they don't tax a particular type of income, and that's going to work out well for you. Or, kind of the most common thing that we work with people on is, let's take your type of income, take where it is that you want to live, and then figure out what is the structure that we can put in place to optimize and legally reduce as low as possible that tax. And maybe you're able to have a business in between, and that can change the nature of the income. Maybe you can do deferral. Maybe there's some sort of a trust structure that you can use, et cetera, et cetera. So anyway, I hope you enjoyed that. I hope it was helpful for you. If you have questions, put them in the comments below. Be aware that, territorial tax, not all it's cracked up to be. And Don't mistake yourself for believing that just because you're going to a territorial tax country that you're not going to get taxed on your income. Quite likely, actually, it will be taxable, but it depends on the type of income. Maybe you will, maybe you won't. You really need to get into those details of the type of income and how they define territoriality and local source income in that country. So I hope that helps. We will see you guys on the next video.